The most dangerous Fed is not the one that panics in front of the cameras. It is the one that steps up to the microphone, talks like it will do whatever it takes, stares down inflation like a gunfighter, and then quietly blinks the moment something frightening lands on its desk. That is the warning gold just got. Not a crash, not a screaming headline. A tell. A small, easy-to-miss flinch that tells you exactly how this movie ends, if you have seen it before. And I have seen it before, which is the whole reason I want to sit with you for a few minutes. If you are retired, if you have spent a working lifetime building something inside a retirement account, the thing that quietly robs a retirement is almost never the crash you can watch on the news. It is a central bank that stands up, promises to hold the line, and then doesn't. So let me give you the answer the title is pointing at, right up front: no games. The first real warning for gold is a Fed that talks tough and flinches. Because tough talk followed by a blink is not bad for the metal. It is the single most bullish thing a Fed can do. Let me show you why, and let me show you the man who proved it. Go back to the 1970s. The Fed had a chairman named Arthur Burns. On paper, a serious man, an economist's economist, a pipe and a scowl and a reputation for toughness. He talked about inflation the way every central banker talks about it, as the enemy, as the thing that must be crushed. And then the world handed him a test. An oil shock hit, energy prices exploded, the economy started to wobble, and Burns had a choice. He could keep his boot on inflation and take the pain, or he could ease up, protect the growth, and tell himself the inflation was somebody else's fault, out of his hands, all about oil. He blinked. He let it run. He convinced himself the fire was temporary and looked the other way while it spread. Now watch what gold did with that decision. At the start of that decade, gold was pinned at $35 an ounce, a fixed number, a rule of the old system. By the end of it, after a chairman who talked tough and kept blinking, gold traded north of 800. That is not a rally. That is a repricing of trust. Gold did not go up because gold changed. Gold went up because the men in charge of the dollar lost their nerve, and everyone who was paying attention figured out that the promise behind the paper was softer than advertised. In my years in the gold and silver world, that is the pattern I have learned to fear and respect more than any chart. The metal does not move on what the Fed says. It moves on the gap between what the Fed says and what the Fed actually does when it gets scared. Here is why that gap matters so much to you, sitting there with your savings. When a central bank keeps its word, when it raises rates and holds them high and genuinely squeezes inflation out of the system, gold usually struggles. The reason is simple. If you can earn a real return, a return above inflation, sitting safely in a treasury, then a lump of metal that pays you no interest looks boring by comparison. That is the honest bear case for gold, and I am not going to hide it from you. A Fed with a spine is gold's natural enemy. But a Fed that promises a spine and then folds, a Fed that lets inflation quietly outrun the interest it pays you, that is a different animal entirely. Because now the safe, sensible thing, the treasury, is quietly losing you purchasing power every year, and the boring lump of metal is the thing holding its value. The whole calculation flips. I think of a man I used to know, a fellow who ran a small machine shop through those years, tool and die, good honest work. He did everything the responsible way. He saved. He kept his money in the bank, in bonds, in the things a careful man is told to trust. And he told me once that the cruelest part of that decade was not that he lost money on paper. On paper, his account looked fine, even grew a little. The cruel part was that he watched the same paycheck buy less and less, watched the price of steel and fuel and groceries climb while the men in Washington kept promising it was under control, and he slowly realized that being responsible had been quietly punished. He was not wiped out by a crash. He was hollowed out by a blink. That is the fear I want you to take seriously, because it is coming back into fashion. And here's where it gets strange, because we are watching a version of that same movie play out right now, and almost nobody on the financial channels will name it for what it is. We have a Fed that talks tougher than it acts. We have leadership that goes out of its way to sound resolute, that says it will not hesitate on inflation, that welcomes the internal fight, and lets the disagreement spill into public view. And underneath all that tough talk, inflation has been running above the target for years. Not a spike, not a headline crisis, just a persistent grinding overshoot that never quite gets crushed. There has been a cooler reading here and there, enough to let everyone exhale and say the worst is behind us. But the trend underneath has been stubborn, sometimes re-accelerating, refusing to lie down. A Fed that is loudly divided about whether to hike or cut is a Fed that is, in the language that matters, uncertain of its own nerve. and gold can smell uncertainty from a mile away. That is the warning. It is not that the Fed did one dramatic thing on one dramatic day. It is that the posture is back. The exact posture burns war, the tough voice over the soft spine, and the metal is responding the way it always has. So let me talk about what a person actually does with that, because understanding the history is worth nothing if you do not connect it to your own money. If you have $100,000 or more sitting in a retirement account, and you are watching the same institutions that blinked in the 70s talk tough again today, then the most important thing I can tell you is that you do not have to just sit and hope they get it right this time. This is exactly why my family put together the free Retirement Wealth Protection Guide. It walks you in plain language through how everyday American retirees are moving a portion of the savings they already have into physical gold and silver, held inside the same kind of retirement account you already own, without triggering taxes and without penalties. And the reason this moment matters, the reason I am telling you now instead of later, is what the biggest, most sophisticated buyers on earth have been doing while the headlines argued about a single data print. For 3 straight years, the world's central banks bought gold at a record pace, more than 1,000 tons a year, roughly double what they averaged the decade before. The people who print the money have been quietly trading their own paper for metal. This is not just for insiders or the wealthy. If you have 100,000 or more in any retirement account, this guide is for you. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. From our family to yours, no obligation, nothing to buy. And if you think a Fed blinking under pressure is some ancient story that could never happen to serious modern central bankers, let me remind you how often the men who guard the money have quietly chosen the easy road. Long before Burns, there was a period when the Fed simply agreed to hold interest rates down to make it cheaper for the government to carry its debts, pinning yields low for years while the politicians spent. It took a formal accord to finally cut that cord and let the Fed act like a central bank again. And even after that, the temptations never stopped. When the old gold-backed dollar became inconvenient, a president closed the gold window and called it a temporary measure. It was never reversed. Temporary is the most expensive word in the language of central banking, because it is what they say right before they blink. Every one of these episodes has the same fingerprint on it. The guardians of the paper deciding that holding the line was too painful and choosing the softer path, and gold quietly keeping the honest score they refused to keep. Now let me take you deeper, because the central banks are the loudest tell, and they deserve a closer look. Ask yourself the simple question the financial media never quite asks out loud. Why would the institutions that create currency out of thin air, the ones with the ultimate confidence in paper money because they make it, choose to pile into a metal that pays no interest and just sits in a vault? They are not doing it for a trade. They are doing it because they know something about the durability of their own promises, and something changed a few years back that lit a fire under them. When one major power had its foreign reserves frozen overnight in a geopolitical fight, every other central bank on earth learned a brutal lesson in real time. Reserves you hold as somebody else's paper can be switched off with a keystroke. Gold sitting in your own vault cannot be frozen, cannot be sanctioned, cannot be voted away in a foreign capital. It answers to no politics. And so the buying accelerated, and it has stayed strong, to the point where gold recently overtook the euro to become the second largest reserve asset held by central banks anywhere in the world, behind only the dollar. Think about that. The smart money, the ultimate insiders, quietly voted a lump of metal above one of the world's major currencies. And that is not even the part that should get your attention most. The part that should get your attention is that the old rules have stopped working. For most of my career, there was a reliable relationship you could set your watch by. When real yields rose, when you could earn more sitting in a bond, gold fell. That was the law. It was gravity. And recently that law broke. Gold has climbed even while real yields stayed stubbornly high, which under the old rulebook should have been impossible. When a market stops obeying the rule that governed it for decades, it is telling you that a new force has entered the room, a force bigger than the interest rate math. That force is trust, or the loss of it. When people stop believing the paper will hold its value, they stop caring what the paper pays them to wait. They just want out. That broken correlation is the market whispering what the central banks already decided out loud. There is one more piece of this worth understanding, because it separates the people who see it early from the people who never see it at all. A blinking Fed does not just lift gold. It changes what safety even means. For a generation, an American retiree was told that safe meant cash and government bonds. that metal was for cranks, that you kept your powder dry in the things Washington stands behind. But safety is only safety if the value holds. A bond that pays you a return smaller than the inflation eating your dollars is not safe. It is a slow, polite loss dressed up in a suit and tie. That is what my machinist never saw coming, and it is what the central banks, the ultimate insiders, have already concluded for themselves, which is why they are trading their own paper for metal they lock in their own vaults. When the people who make the money stop trusting the money, that is not a footnote. That is the story. Now I owe you the honest side of this because if I only tell you the bullish half, I am no better than the hype channels I cannot stand. So here is the caution, plainly. Gold does not go up in a straight line, and anyone who tells you it does is selling you something. It set a record high not long ago and then pulled back hard, and it can pull back again. There will be stretches where it feels like dead money, where a shakeout knocks it down, and the same media that ignored it on the way up shows up to dance on its grave. I have watched that happen more than once. Back in the taper tantrum years, a mere hint that the Fed might slow its money printing was enough to knock gold down by roughly a quarter, and it was brutal for anyone who had bought at the top with borrowed conviction. And if this Fed genuinely surprises everyone, if it finds the nerve Burns never had and truly crushes inflation with a spine of steel, gold will have a hard time. I do not think that is the likely path given everything I just showed you, but I am not going to insult you by pretending I know the future. This is a case, an honest reading of history and structure. It is not a guarantee, and it is not personal financial advice. What it is a warning worth understanding before the crowd does. Because here is the truth about being early, and I want you to really hear this. The best moment to understand a shift like this is the moment it feels least urgent, the moment when the news is arguing about whether inflation ticked up or down last month, when your neighbor thinks gold is a rock for paranoid people, when there is no line at the coin shop and no panic in the air. That quiet is not the absence of the story. That quiet is the opportunity. The central banks are not waiting for the all clear. The old correlations are already breaking, and by the time this is obvious to everyone, by the time it is the lead story and every advisor on television is suddenly recommending it, the comfortable, patient part of this move will be behind us. The people who understood the Burns pattern did not need a headline to tell them. They read the flinch. You are reading it right now, which puts you ahead of almost everyone who will eventually arrive at the same conclusion, just later and at a worse price. So let me be practical about your own position for a moment, because principles matter more than predictions. The point of owning some metal is not to get rich on it. It is to make sure that a shakeout, or a decade of quiet erosion like my machinist friend lived through, can never hollow out what you spent a lifetime building. That means owning a portion, sized so you would never be forced to sell it at the bottom in a panic. It means owning the real thing, physical metal you actually hold, not a paper claim that can evaporate when everyone reaches for it at once, because on the exchanges there are far more paper claims floating around than there is deliverable metal to back them. And it means never treating this as a trade to time, but as insurance you own before you need it. Insurance is always cheap when nothing is on fire. It is unbuyable once the smoke is in the room. Think back to that machinist one more time, because he is the whole point. He was not a foolish man. He was a careful one, and being careful is exactly what cost him, because careful in that era meant trusting a paper promise while the men in charge quietly let it soften. His mistake was not recklessness. It was faith in a Fed that talked tough and blinked. You do not have to make the same mistake, because you have the one thing he did not. You have the pattern in front of you, named and explained before it becomes obvious. That is a rare gift, and it has a short shelf life. Which brings me to the most important thing I can leave you with. This decision, the choice to protect and diversify a portion of what you have built, is one of the few big financial moves that is still cheap and still reversible right now, precisely because nothing feels like an emergency yet. That window is open today. This is why my family created the free Retirement Wealth Protection Guide, and why we also offer a free, no-obligation, one-on-one educational web conference for folks with $100,000 or more in their retirement accounts who watch these all the way through, which tells me you are the kind of person who takes this seriously. Just mention that you watch this full video. We will sit down with you, walk through how this actually works for your situation, and answer your questions with no pressure and nothing to buy. And this is not only about you. It is about what you pass on, the portion of your life's work that your children and your grandchildren will one day inherit. Protecting that, diversifying it so a blink from Washington can never quietly erase it, is one of the last most loving things a person gets to do with what they built. If you are watching on your television, scan the QR code on your screen right now. If you are on your phone or your computer, go to readfamilyguide.com. From our family to yours. Because in the end, this was never really about a single Fed meeting or a single number in a headline. It is about a chairman decades ago who talked like a hawk and flinched like everyone else, and a metal that has been keeping honest score on that kind of nerve for a very long time. The warning gold just got is not a crash. It is a flinch. And the people who learn to read the flinch instead of waiting for the crash are the ones who protect what matters before the crowd ever knows there was something to protect.